Economists don't know when the decade-long expansion, now the longest in American history, will end. But here are the indicators they will be watching to figure it out. The tsunami of troubling economic news is taking its toll on consumers, investors, borrowers, and would-be homeowners. It's understandable that you may be frightened about how all this will impact your finances. Feel what you feel, but don't make irrational moves based on your fear. If you react before thinking long-term about a financial move, you can make things worse. So in this video, we will discuss some key points about the recession is coming and what you need to know. Hello, and welcome to my channel. Hit the subscribe button and press the bell icon for more informative and amazing videos. Let's get started. Number 1. What typically happens in a recession? It's always helpful to go back and review recession outcomes so that we can manage expectations. While every recession varies in terms of length, severity, and consequences, we tend to see more layoffs during economic downturns. Accessing the market for credit may also become harder, and banks could be slower to lend because they're worried about default rates. If the Federal Reserve continues to raise rates to clamp down on inflation, then we might see an increase in borrowing costs. So, even if you qualify for a loan or credit card, the interest rate may be higher than it was in the prior year. We're already seeing this in the mortgage markets, where the average rate on a 30-year fixed mortgage is over 5%, the highest level since 2009. Number 2. Don't rebalance just yet. Rebalancing your portfolio, which involves buying and selling investments to restore your original asset allocation or a mix of stocks, bonds, and other investments, is usually a good idea, but not during a market sell-off. When things are looking bleak, do your best to hold on to your investments. Selling during market lows can be one of the worst things you can do for your portfolio. It locks in losses. When the market evens out down the road, rebalancing may be in order. When you do eventually rebalance, don't discredit the emotions you had during recent stock market crashes. Knowing how you've reacted during past market fluctuations should be factored into how you allocate your investments going forward. Suppose you pulled your money out of the market or otherwise couldn't deal with the volatility. In that case, you may want to rebalance into a slightly more conservative portfolio so you can feel confident and weather future market drops with less stress. Number 3. Buy the dip if you can. Thinking of market crashes as fire sales can help curb the panic. If you're in the kind of financially stable position that allows you to buy in a downturn, you could be setting yourself up for success down the line by doing so. Since timing the market perfectly is next to impossible, don't worry about trying to find the exact moment when stocks are at their lowest. Pick a few investments you've always wanted to own and give yourself a price threshold you feel comfortable with. If they drop to or below that threshold, you may get a bargain. Here's a primer on how to invest in stocks if you're new to this. If you're already feeling financially strapped or maybe facing unemployment, don't hedge your bets on a volatile market. Your money is better utilized in an emergency fund than on a risky investment. Only try to buy the dip if you can stand to lose that money. Number 4. Invest in the necessities. Utilities are a classic lower-risk investment, but why? Utilities are essential, and hopefully, most people will not have to forego them during a recession. Household goods and other necessities are also considered recession-friendly investments. It would be rash to move your entire portfolio in this direction, but adding a utilities or consumer staples index fund or exchange-traded fund can add stability to your portfolio even if the economy starts to feel uncertain. Here's more on investing in index funds. You'll probably see lots of articles claiming a particular investment is recession-proof. But don't buy into the noise without researching the company and industry. And regardless of how much research you do, resist the urge to try to beat the market. Number 5. Stay invested if you can. Try not to panic about the scary headlines, and remember that staying invested is almost always the best response. Historically speaking, investors who hold on to their investments through recessions see their portfolios completely recover, and individuals who don't invest in the market at all lose out. Part of staying invested means protecting your portfolio from emergency expenses. Losing a job or having no emergency fund can force investors to dip into their investments. But most retirement accounts charge strong penalties and often taxes for early distributions. The general aim is to have 3 to 6 months of living expenses saved in an online savings account, but if you can't get there right now, you're not alone in that struggle. Even a cash cushion of $500 helps. If you don't have any emergency savings, there are other strategies you can use to deal with a financial setback. That's all for today. I hope you guys liked the video, and for more stuff like this, please subscribe to my channel and hit the bell icon for notifications. See you soon.